Welcome to Finance Today for April 21st, 2025. I'm your host, bringing you the latest financial news and market insights. Today, we'll cover several important stories affecting the markets, economy, and your investments. Let's get started with our daily financial briefing. Start. In just 3 weeks since President Trump kicked off a global trade war, we're already seeing the initial fallout. The International Monetary Fund is lowering its outlook for economic growth. On Tuesday, we'll get a first look at how manufacturing and services activity has been hit since Trump's tariffs were introduced. Next up, major economies are releasing their business surveys. This will give finance bigwigs a chance to measure the early damage from Trump's attempt to retool global trade. The IMF is warning of a downturn but not a recession, and predicts a rise in inflation for some countries. But history suggests the final impact could be worse than the IMF's initial assessment. Federal Reserve Chair Jerome Powell says the US Central Bank is ready to wait for a clearer picture before changing policy. Meanwhile, European Central Bank Chief Christine Lagarde remains uncertain about the peak of this uncertainty. End. In a nutshell, the global economy is on shaky ground, and it looks like the clouds aren't going to lift anytime soon. The coming days, featuring a meeting of Group of 20 finance chiefs, could potentially cool down global trade tensions. So, the world is waiting, watching, and hoping for a more resilient global economy, not a drift towards division. Stay tuned for more updates. Now, let's examine money moves retirees can make now to reduce next year's taxes. Script. Hey folks, today we're talking about your retirement accounts and how to plan for next year's tax return. Remember, tax planning is a long-term game, not a yearly chore. Retirees, you've got a whole mix of accounts to manage: 401k, IRAs, Roth IRAs, and more. So let's dive in. This April, your management strategies will affect next year's tax bill. This is a prime time to review your financial pain points and start preparing for a potentially declining market. Now, if you're looking back on last year with a smile, you're not alone. Our major indices, the S&P 500, Dow Jones and Nasdaq, saw gains of 23%, 13%, and a whopping 29% respectively. But that means higher required minimum distributions or withdrawals this year, which will be taxed as regular income. But here's the silver lining. Although more money is coming out, it's still at historically low tax rates. If you can withdraw while rates are low, you're still winning. Remember, the first required minimum distribution should be taken in the year you reach age 73. But you can delay this until April 1st of the following year. This amount is calculated by dividing your retirement account balance as of December 31 of the last year by a life expectancy factor. In conclusion, always aim to pay taxes at the lowest rates, which might be right now. So plan wisely and stay ahead of the game. Next up, we look at Americans are expecting a tariff-fueled price surge. A new Fed survey says they're right. Hey there! Let's talk tariffs. A consumer sentiment survey from the University of Michigan indicates that expectations for inflation a year from now are the highest we've seen since '81. Why? Well, thank Trump's tariff policies for that one. A recent study from the Boston Fed tells us that Americans are spot on to expect the cost of tariffs to pinch their wallets. Businesses surveyed are expecting costs to rise and plan to pass the buck to consumers through price increases. Interestingly, the sharpest spikes are predicted under a low tariff scenario, rather than high tariff or uncertain ones. Now remember folks, a tariff is essentially a tax on imported goods, usually paid by the company doing the importing, not the exporting country. Businesses often pass these costs on to us, the consumers. According to the Boston Fed, it will take about 2 years for tariff-induced price increases to fully hit us. What remains unclear is how domestic firms' prices will be affected, which could further fuel inflation. Economists warn us to brace for an acceleration in inflation, especially for imports from China, which are staring at a whopping 145% tariff rate. Even as companies do their best to cushion the blow, we're already seeing price hikes being implemented or planned out. So, what's the takeaway? Tariffs are pushing the cost of living higher, and we're all going to feel it in our wallets. So buckle up, because it looks like we're in for a bumpy ride. Moving on to our next story. How to think about earnings estimates during volatile times. All right, folks, let's dive into the world of Wall Street. Earnings estimates for the next 12 months are on the rise, while projections for 2025 and 2026 are dropping. It sounds confusing, right? But here's the thing. It's all about the passage of time. These estimates are constantly shifting as new information comes in, and analysts adjust their predictions. Have a look at this. Morgan Stanley's Michael Wilson has provided a neat visualization of this dynamic. The left chart shows the S&P 500's next 12 months earnings growing, while the right chart shows 2025 and 2026 estimates declining. But what does this mean for us? Well, the growth in rolling future earnings seems to be offsetting the falling expectations for static periods. And this is crucial, especially when we talk about valuation metrics like the forward price earnings ratio. However, there's a catch. Uncertainty is sky high, and the current earnings estimates might be stale. So whether we're talking about next 12 months or calendar year estimates, they could both be off. Wrap-up time. When it comes to earnings estimates, be aware that they can shift over time. Next 12 months' earnings are arguably more valuable, as they give a better reflection of future expectations which heavily influence stock prices. Before we wrap up, let's touch on some recent economic developments. Retail sales jumped 1.4% in March, reaching a record $734.9 billion. But tread carefully. There's evidence that consumers have been front-running tariffs, particularly in areas like car sales. That's all for today, folks. Remember, in the world of finance, timing is everything. Stay sharp and stay informed. Now let's examine Tesla. Alphabet highlight earnings rush as tariff fallout drives markets. What to know this week? The week ahead in Wall Street is set to be a roller coaster, folks, as we remain at the mercy of tariffs and Trump's policies. Last week saw the S&P 500 fall by around 1.5%, with the Nasdaq Composite and Dow Jones each shedding 2.6% across 4 trading days. And this week, we're expecting quarterly results from over 120 S&P 500 companies, including heavy hitters Alphabet, Tesla, Chipotle, Boeing, and Verizon. But the elephant in the room remains Trump's tariffs. The market took a hit on Wednesday as investors began to feel the sting of these tariffs on major companies and the broader US economic outlook. Nvidia's announcement of a $5.5 billion charges due to US government restrictions on its chip exports to China kicked off a sell-off, which was only intensified by Federal Reserve Chair Jerome Powell's announcement that the central bank would wait for greater clarity before considering any interest rate adjustments. We've only seen first quarter earnings from 12% of S&P 500 companies so far, and the initial numbers are weaker than average. As more companies report in this week, investors will get a clearer picture of the market's direction. So what's the takeaway? Keep an eye on the tariff news and the results from major S&P 500 companies. As Citi's head of US equity trading strategy, Stuart Kaiser, puts it, we need to see some good news on the tariff front, especially with our key trade partners. If not, we may need to start considering the possibility of a recession. Stay tuned, folks. It's going to be an interesting week on Wall Street. Our next financial story focuses on how Trump has wiped out the teams that protect student borrowers. Hey there, let's dive straight into a major shakeup happening in the student loan space. The Trump administration has been slashing oversight of federal student loan servicers, and this week we saw the Consumer Financial Protection Bureau instructing staff to push student loan matters to the back burner, aiming to cut about 90% of the workforce. This agency has been crucial in ensuring loan servicers are following federal consumer laws since it was formed in 2010. Over at the Department of Education, teams responsible for checking loan servicers' work have been wiped out due to mass layoffs. Now, borrower advocates are sounding the alarm, claiming that students will have less protection if loan servicers, already a magnet for consumer complaints, mishandle their loans. Even Jonathan Butcher, a research fellow at the Heritage Foundation, called out the administration for letting go of key staff that ensure accountability within the loan program. He expressed hope for a plan to replace their function, however, the Trump administration has not provided any clear plans for the transition. Now, dealing with servicers has always been a pain for borrowers. They've been known for messing up basic tasks and saving costs at the expense of customer service. And with the Department of Education uncovering millions of servicer errors, including cases of borrowers being billed over $100,000 at once, the situation looks dire. So what's the takeaway? With the current administration cutting back on oversight of loan servicers, there are real worries about the potential for increased mishandling of student loans and decreased accountability. It's a situation we'll be keeping a close eye on. Stay tuned. Moving on to our next story. The stock market may not have fully priced in a recession. Chart of the week. Welcome to Yahoo Finance. The stock market is in a whirlwind right now due to President Trump's expansive tariffs. The stock market has been hit hard with recession fears on the rise. The big question is how much of an economic slowdown has the recent stock market sell-off accounted for? History suggests that if we are headed for a recession, stocks might have more falling to do. Goldman Sachs economists have recently estimated a 45% chance of a recession in the next 12 months, significantly higher than the historical average of 15%. Bank giants like JP Morgan and Renaissance Macro also predict a recession later this year. However, there's a flip side. If the Trump administration lowers some threatened tariffs, we might just avoid a recession. But as of now, that doesn't seem likely. In response to these fears, Wall Street strategists have been lowering their price targets for the S&P 500 for this year. Citi, for instance, recently dropped its year-end S&P 500 price target to 5,800 from 6,500. In conclusion, if trade negotiations don't materialize and tariffs continue to weigh heavily on the economy, we might be looking at an actual recession. Keep your eyes on the market, folks. This is Yahoo Finance, bringing you the latest financial news and analysis. Stay tuned for more updates. Let's continue with another important development. Worried about a job loss? Time to pump up your emergency savings. Hey there! As job loss anxiety reaches levels similar to those during the pandemic, Americans are increasingly worried about the future. A survey by the Federal Reserve Bank of New York found that unemployment expectations jumped to 44%, the highest reading since April 2020. This growing concern is affecting all age, education, and income groups. The chatter of a looming recession, inflation, and mass layoffs has everyone on edge. Instead of worrying, use this fear to get financially fit. Turbocharge your emergency savings fund. It's what's on everyone's mind as they prepare for a potential financial hit. Having cash on hand for a few months of living expenses helps maintain calm in these uncertain times. Creating a successful saving habit starts with setting up an automatic direct deposit from your paycheck into a high-yield savings account. Start small and stay consistent. Aim for a year's worth of expenses in your savings account, but if that's daunting, start with 4 months and build from there. Start tracking your spending, identify areas to cut back, and create an emergency expense list. With new federal rules, you may be able to withdraw up to $1,000 annually from a retirement account for emergencies without a penalty. So let's ride this storm out. Remember, preparation is key, and a solid savings habit can make all the difference. Stay financially fit, folks. Our next financial story focuses on can Trump fire Powell? The Supreme Court could make it easier. President Trump is considering giving Federal Reserve Chair Jerome Powell the boot. The legality of such a move could soon be under the microscope of the Supreme Court. Trump's asked the court to back his decision to dismiss the chairs of 2 independent agencies, challenging a 90-year-old precedent that limits presidential power to fire agency board members, unless there's neglect or malfeasance involved. Trump hasn't stopped there either. He's also issued pink slips to leaders of the Federal Trade Commission and the Federal Election Commission, and those dismissals are being legally challenged too. He's even been musing publicly about his wish to show Powell the exit door, stating his termination cannot come fast enough. Behind closed doors, Trump's had talks with a potential replacement, former Fed Governor Kevin Warsh. However, some of Trump's economic aides caution against giving Powell the shove before his term ends in May 2026. But Powell isn't taking this lying down. He's stressed that his removal isn't permitted by law and doesn't believe the Supreme Court case will impact the Fed. But the central bank is still keeping a close eye on it. So, can Trump legally fire Powell and other agency chiefs? That's a tricky question, with a mix of legal, political, and financial risks making it a tough call. The answer lies in the interpretation of the US Constitution's Article 2, which gives executive power to the president. This saga is one to watch, folks. Stay tuned. Let's continue with another important development. It was supposed to be the best spring home buying season in years. Then came the tariffs. Yahoo Finance is reporting on the impact of recent market volatility on the home buying season. The ingredients were all there for a solid spring home buying season: more inventory, steady mortgage rates, and increased showings. However, the volatility following Trump's tariff announcements has threatened to derail it all. Consumer confidence is taking a hit as fears of inflation and recession grow. Home sellers are worried about their property values, and buyers are hesitant to make offers in such an uncertain market. We could be headed for a third year of disappointing home sales, with last year seeing the lowest level since 1995. It's not all doom and gloom, though. Historically, home prices have risen through past stock market corrections and have rebounded sharply when the correction ends. But the combo of falling stock prices and rising interest rates could lead to further declines in sales volumes. A recent Redfin survey found that 24% of respondents are cancelling plans to make a major purchase due to tariffs. In conclusion, the market volatility is causing uncertainty and hesitation in the housing market, potentially leading to another weak year for home sales. That concludes our financial news summary for April 21st. Thank you for watching Finance Today. If you found this information valuable, please consider subscribing for daily financial updates. Stay informed, and I'll see you tomorrow for more market insights.